So today's topic is accounting for leases. Okay. So if you want to start a business, you require a premise. This premise or this building, whatever you want, you can say, or this property, either you can buy or you can lease it. Okay. So what is the difference between buying, leasing and taking a property on rent? What is the difference? See, if you want to buy this property, you have to approach a financial institution like a bank, and then you have to make some down payment for that, like 20% or something for that property. Depends upon the country, like geography. And then rest of the amount the bank will finance you to buy this property, and you have to pay interest to the bank along with your principal. And that anyone has taken housing loan or commercial property loan or whatever, you know how what is the schedule of that loan amortization schedule. Okay, there will be a EMI payment, easy monthly installment, which the person who has taken a loan has to make easy monthly installment payment to the bank. That EMI will be a combination of principal element of the property plus interest, correct? And this will vary with the passage of time. In the during the inception, the interest amount will be very high and the principal amount will be very nominal. The amount will be fixed. Suppose 30,000 is the EMI. If you have taken a house, you have to make a, if you have taken a house, you have taken a housing loan to finance that house. So for that housing loan, you have to make a EMI payment of 30,000 per month for 30 years, for example. So this 30,000 will be divided in these two parts, principal and interest. In the beginning, the principal element will be very less and the interest element will be very high. Why? Because bank knows if some prepayment is done, or the person who has taken loan, if within 6 months or 1 year, if he pays off the entire amount, they will lose business. So they want interest in the beginning, and in the end, what happens as the times passes by, suppose the EMI payment is 30,000. In this, 3,000 is the principal payment and 27,000 is the interest payment, correct? Yes, Zirin, are you understanding, following?
Yes, sir. Yes.
So now bank knows that this 27,000 is of no use for the customer, because customer is losing this entire money because bank is charging interest on that money whatever bank has given. The customer's reduction of principal will be by 3,000. Suppose the loan amount is 30 lakhs. So out of 30 lakhs, 3,000 will be deducted and the outstanding amount is 27 lakhs 3,000. 27 lakhs 97,000, correct? Sorry, 29
Yes, sir.
lakhs 97,000, correct?
Yes, sir.
After deducting 3,000, the principal element from this loan amount, outstanding loan amount, was left over 29 lakhs 97,000. On
29 lakhs.
this, yeah, on this, the next interest would be charged. So what happens, since the principal has reduced from 30 lakhs to 29 lakhs 97,000, what will happen? The principal amount will increase. It will become 3,100, for example, and this will become 27,000 something change. Okay, you can just check it out that. So what happens, slowly steadily this principal element goes on increasing, and at the end, in the 30th year, you would be paying 30,000 EMI. In that, 29,900 would be your principal element and 100 rupees will be interest element. Maybe like that. I'm just giving a hypothetical example. Okay. Understood what I'm explaining?
Yes, sir.
Yeah. So, but this particular, we were speaking about housing loan. If you want to do a business, you want a premise for that. And the premise you want in a prime area or in a prime locality. And to buy a property in a prime locality, it's a very costly affair. You have to shell out 1 or 2 crore rupees to buy a small premise to start your business. That is not affordable for many of the people. So what people do is, instead of taking a loan, buying this property, commercial property, I'm not speaking about residential property. Residential property everyone wants. like even a person who's doing a job or a business, everyone from any walk of life would want a residential property, but commercial is required only by the businessman. And if a businessman buys a commercial property, it's very costly for him. He has to spend a lot of money, and the interest rate would be high on commercial properties when compared to residential properties. Point number two. And if he puts that much of money in buying the property and starts the business, that much capital he should have. We generally don't see that much capital people have. Okay. And third point is, if he puts the entire money into that, he will be left over with less cash to expand his business in the future. So those kind of risks he doesn't want to take. Only the people who are very conservative, they would go with this kind of strategies. Others would rather lease the property. They would take the property on lease. Now, what is this leasing? Lease again is divided into two parts, but before going into those two parts, we will understand what is leasing. So you understood what are the cons of buying. Okay,
Yes, sir.
you have to shell out a bigger amount. The interest rate would be high. And one more thing I forgot to explain, your eligibility criteria. What is that?
Eligibility criteria.
Maybe you may not be eligible to like get a loan. So if you are not eligible to get a loan, or you don't match the eligibility criteria, then how? Then you cannot buy the property. So the option left over for you is, of course, leasing the property. So now let's speak about lease. Lease is nothing but an agreement or a contract between two parties. One party is the lessor and the other party is the lessee. Lessor leases the property to lessee, and lessee takes the property from the lessor on lease for some consideration. That means he will make lease rental or lease payments to lessor. Okay. And the point number two is, this lesser, there are two types of leases now. Did you understand what is lease agreement or contract? As the contract of lease is nothing but it is such a contract whereby two parties, they agree with each other regarding the exchange of property for some consideration. Okay. And now this exchange of property is not exactly buying the property. This is with lease, lessee has the right to use the property. What is that? What is that I have written? Right to
Use the property.
Use the property, right to use the asset. He is not the owner. Who is the owner? Lessor. But who has the rights to use the asset? Lessee. Correct?
Lessee. Yes.
Yeah. And there are two types of leases: operating lease, finance lease. Operating lease generally is an off balance sheet item in general. That means this is a lease whereby you take the property from the lessor for some short duration, short span of time, maybe less than a year. No, I'm not saying that it cannot be more than a year. It can be more than a year, but generally for operating lease, the properties, whatever we take, or the instruments, whatever we take on lease, is for a short duration of time, short term lease. Okay. So what happens in case of operating lease? The lessor gives the property on lease. Okay, leases out the asset to the lessee, and he doesn't transfer the risk and reward associated with the property to the or on the lessee. The risk and reward from the risk, that is the risk from the property, whatever the risk would be there with the property, or reward whatever would be there with the property, would be retained by the lessor. Got my point?
Yes.
So risk and reward would be, reward in the sense he will be charging the lease rental to you, and he would be the one who would take care of the property. If any damage happens to the property, who would be taking care of the property, or who would be bearing those damages or bearing any kind of damage to the asset? Lessor. Got my point?
It's a kind of long-term rental agreement.
See, there's a difference between rent and lease. You should be very careful in this. Rent is nothing but, yeah, as you said, long-term rental agreement. That is a good terminology. Rent is something which you pay every month. If you don't pay next month, the rent agreement comes to an end. Correct?
Yes.
Next month, every month you need to pay to renew. Lease is something which is for a longer period of time. That's you have said, you have given a proper you have a good idea about it. I understand. So lease is for a longer period of time. Okay. Generally, the
Yes.
difference between the operating lease and finance lease is this can also be for a longer period of time, but generally for operating lease, for short-term assets and the assets which are of which you don't want to use for a very long period of time, you go for operating lease. And there's a difference between operating lease and finance lease. Finance lease can also be termed as capital lease. The difference I'm explaining very clearly. In case of operating lease, the risk of the property is with the lessor. The risk is not transferred onto the lessee. Any damages happen to the property, lessor will take care of that. And point number 2 is, in this there is no purchase option of the property. Got it?
Yes, sir.
That means at the end of the lease term, lessee is not going to have a purchase option. The property will still be with the lessor, even though you take the property on lease for longer period of time. And here generally the lease is renewed after a certain period of time. Okay, short term lease kind of. But in case of finance lease, the lease is for a very long term. The risk and reward of the property is transferred to lessee. Any damage happens to property, who is responsible?
Let's see.
And lessee also has purchase option. So I'll give you a general example to generalize this and make the things easy for you. See what happens. Generally, suppose this is Indigo Airlines. Indigo Airlines want 20 flights or 20 aircrafts. It doesn't have that much of money. So what it does, now it wants finance for that. Okay. It doesn't want to go for buying the aircrafts. Why? Because I've already explained you what is the problem with buying. They have to make a down payment, correct?
Yes, sir.
Instead of that, what they do, they approach lessors. So what lessor would do is, lessor would buy these 20 aircrafts and lease it out to whom?
To Indigo.
Indigo. That
Indigo,
means
yes.
you are not buying the asset. On behalf of you, someone else is buying and leasing out this to you, correct?
Yes, sir.
Who can do that? The Boeing company itself, the manufacturer, or Airbus. So these big companies, they know it is not easy to buy aircrafts, not a small amount. So they themselves manufacture, they themselves lease it out. And what Indigo has to do, they have to make a fixed payment to Boeing for some 10, 20 years, 30 years. And that becomes a fixed income for Boeing company, correct?
Yes, sir.
So that rotate, they can also put, like they are at peace. If Boeing and Airbus cannot do, then banks and insurance companies do. Because these guys have a lot of money, surplus money. What they do, they buy the aircraft from Boeing or Airbus, lease it out to Indigo. Indigo will pay the lease payment. Okay? Or
Yes,
lease
sir.
rental or whatever you want, you can say. Understood?
Yes, sir.
I'm just explaining the process. There is one more one more thing. So this, whatever I'm explaining, this 20 aircrafts and like the bank or insurance company buys it for the Indigo Airlines, leases out it to Indigo Airlines and collects lease rental. And at the end of the lease term, suppose lease term is for 20 years, for example, or 10 years. Who will buy the asset? Indigo will be having the purchase option, correct?
Yes, sir.
What will these guys do with that asset? They don't want it. They just want a fixed income because they have good amount. They have surplus money with them. So since they have surplus money with them, they want some fixed income. Okay. So generally what they will do, they will charge a higher interest than the loan, whatever you're going to take. The interest would be on a higher side, but you're not going, the Indigo Airlines is not making some down payment, correct or wrong?
Yes, sir.
So
Release
like
amount.
it will be similar to loan amortization schedule, which I explained you right now. In that case, principal plus interest was supposed to be paid now. In this also, There will be, suppose you take a property for 6 lakhs on lease for a year, divide by 12, 50,000 is what you need to make the payment every month for lease. And this will be a combination of interest, interest on outstanding amount, correct? And principal or the asset value, correct? So what
Yes, sir.
happens in the first month, you make the 50,000 payment. Suppose the principal is 30,000, for example, that will be reduced from 6 lakhs and 5 lakhs 70,000, whatever is outstanding on that interest will be charged.
When the like Indigo tries to like buy at the end, will he get any discount as he was paying from these many years, the lease
Oh,
amount?
actually it's like a finance now. It becomes Indigo Airlines aircraft.
Yeah, but when he's going to buy, he's
See, that
going to get
discount they are
like
not going to get. They will get incentives. When you make a lease agreement with the lessor, as you are going to become a customer of that lessor is going to give you some incentives. That's it.
yes, sir.
No discount. Why discount? If you are taking a housing loan, you're buying that asset. Are you getting any discount?
Hmm. No.
No. And this kind of leases are non-cancelable. Generally, if you cancel, then penalty. There will be a penalty on you. Okay.
Yes.
So you understood now what is happening? The principal
Yes, sir.
element and interest element on
Yes, sir.
5,70,000 they will charge the interest to you. Correct?
Yes, sir. I got it.
Yeah. So this is what is the leasing all about. And there is one more thing called sale and lease back. Generally, it's not there for you, but I'm explaining. What is this sale and lease back? It's nothing but suppose you have a ice cream manufacturing unit. You have a machine. This machine you are kind of selling to someone, some lessors. Okay. He is buying this particular machine from you. That means he is taking the papers, property papers from you, this machine's papers, and giving you loan. Correct?
Yes, sir.
So you are getting money. With that money, what you are going to do? You are going to put a cold coffee unit. So what is the benefit? You got the money with which you started a business expansion you have done, and the machine is still with you because you have also leased the machine. You sold it and leased it back, correct?
Yes, sir.
Hello.
Yes, sir. I got it.
Yeah, and the lessor is enjoying the fixed payments. That's it. So this is what actually your chapter is almost done, with this, but I'm not going to leave in that way. I'm going to explain you. I'm going to explain you a practical question also. So you can see this slide. Leasing environment, who are players, advantages of leasing, conceptual nature of lease, I've explained you. Accounting by lessee, like capitalization criteria, okay. Now I need to explain you something regarding accounting for leases. See, in case of operating lease, see, in IFRS the treatments are different, in US GAAP the treatments are different, or short-term lease. If you take a property on short-term lease, if you take a computer, laptop on lease, okay, you make a lease rental payment, correct?
Yes, sir.
And you show that in your P&L account as an expense. But if you're taking a property on finance lease or capital lease, then what happens? You have the right of use of that asset. You have right to use that asset, correct?
Yes, sir.
So right to use asset will be shown in the asset side of balance sheet. You are capitalizing it. What are you doing?
Capitalizing.
When you show in balance sheet, you capitalize. And in this case, you expensed. So operating lease, you will expense. In general, short-term leases, you will expense. In case of finance lease, you will
Capitalize.
capitalize. And then also there is a lease liability created. Okay. The asset you have and the liability is also created. So slowly, steadily what happens? the asset what you are showing in your balance sheet, you are deriving economic benefits out of it. So that will be getting depreciated. And here you will be paying, you will be making the payments, correct? So liability will also come to an end after, at the end of the asset's life, correct or wrong?
Yes, sir, correct.
So your lease expense would be a combination of capital cost, which is depreciation, plus the finance cost, which is interest. That's it. So here we are. Lessee would capitalize the asset. Okay. We will see what is capital lease and finance lease. Just a second, Zarina. So, as you can see here, capitalization criteria, accounting differences. So this we will be seeing. And I already explained you why you are like leasing the property, what is the difference of what kind of benefit you have with leasing when compared to direct financing from the bank. Okay, we will discuss all this now. So can you read this point, Zarina? Lease is a contractual agreement between a lessor and a lessee that gives the lessee the right to use specific property owned by lessor for a specific period of time. Correct? Hello?
Hello, yes, sir.
Yeah, you're following this now?
Yes, yes, I'm following. Actually, I was
And
on.
these are the things which generally go are a part of lease agreements. Largest group of leased equipment involves IT, transportation, trucks, aircraft, rail, construction, agriculture. They all this kind of assets go for lease. Who are the players? And there's these guys: banks, captive leasing companies, independents. So anyone can lease out. If you have a property, you can lease it out. If there are lessors, companies, leasing companies, they can lease it out. Some companies, they take properties from people and give it for lease. So that is called subleasing. When you go to a foreign country, you generally don't have any interaction with any what we say owners. These guys take property on lease and these properties, these guys take property from those guys and lease it out to you. It's called sublease. They leased out and they leased
It's
out to
leased
you,
twice.
correct?
Yes,
Advantages of leasing: 100% financing at fixed rates. So you are not paying any down payment, isn't it so?
yes, sir.
And the fixed rate that is not going to change. Protection against obsolescence, I told you in case of operating lease. Flexibility, yes, sometimes if you don't have money also you can have a adjustment with them. You can make 2 or 3 payment, you can do a lump sum payment. Less costly financing. Tax advantages, oh yes, this point I did not explain you. So whatever the lease rental, you make the, see, in case of borrowing, there is an interest cost which you incur. You can claim deduction on this, as well as you can claim deduction on lease rentals also. So if you think that if I borrow and if I make the interest payment and I can claim deduction, it is not. This in this also you are getting that feature. So again, leasing is more attractive option. And off balance sheet financing. As I said, you many people take property on lease, and in case of operating lease, they need not show that in the balance sheet. They can directly. So what they do, they try to hide what? Got it?
Lease obligation of lease liabilities. Yes, sir.
Yeah. In case of operating lease, you need not show any kind of liability. Now you are showing the asset and directly you are showing the rental. Correct?
Yes, sir.
The expense. Yeah. Conceptual nature of lease: capitalize a lease that transfers substantially all of the benefit and risk of property ownership provided the lease is non-cancelable. Is this nothing but about the finance lease? What did I say about finance lease or capital lease? In case of finance lease, all the risk and reward related to property is transferred to whom? Lessee, correct?
Yes, yes, sir.
And he gets the right of use of asset. So he has to show the asset in the asset side of balance sheet, and also liability side he has to show the liability,
Lease
lease
obligation.
liability,
Yes, sir.
correct or wrong?
Yes, sir.
And that lease is not cancelable. Leases that do not transfer substantially all the benefit and risk of ownership are operating leases. I said this already.
Yes, sir.
So leasing environment. So in case of capital lease, you capitalize the asset. So leased equipment comes in the debit and the lease liability in the credit. This is also created simultaneously, correct?
Yes, sir.
Here it is just a lease rental to cash. That's it. Just give a reading to this. I'll move forward. So accounting by lessee: if the lessee capitalizes a lease, the lessee records an asset and liability generally equal to present value of rental payments. Of course, see what happens. Now you suppose you are a lessee, you have taken a property on lease. So what is that at which you are going to measure that property, or what is the value of that property you are going to show in your books? That is nothing but equal to present value of lease
Rental
payments. What is
payment.
that?
Yes, sir.
So we can write right of use asset is equal to present value of lease payments. So, and then you will be definitely recording depreciation for the lease asset and also the lease payments. Whatever you will be doing would be combination of interest and principal. Isn't it so?
Yes, sir.
Is anybody following? Surely.
Yes, I'm following. Actually, I didn't keep the headphone. That's why I think you're not getting my voice.
Acha, acha, okay. Now, the next and the see in US GAAP, like the US GAAP, these guys what they have done is they have given a specific criteria. Okay, if that criteria is met, then the lease would be called as a capital lease or a finance lease. So to record a lease as capital lease, the lease must be non-cancelable, first point, and one or more of four criteria must be met. Any one or more than one. First, the lessor transfers the ownership to lessee at the end of the lease term, correct?
Yes, sir.
Contains a bargain purchase option, as you said, some discount would be there or not. There can be. Lease term is equal to or greater than 75% of the estimated economic life of the leased property. So at least the lessee should have the property for more than 75% of the lifetime of the asset. Economic life, estimated
Yes, sir.
economic life. Okay.
Yes,
The
sir.
asset can be with you, but it should give you economic benefits. So that That means you can take maximum benefit of that asset. If that is not there, then even that asset is of no use for you.
Yes,
But the
sir.
criteria is to meet any one of them or more than one. Present value of minimum lease payments equals or exceeds 90% of the fair value of lease property. That means whatever the present value of the future lease payments you are calculating today, that should be equivalent to 90% of the market value of that property which you are taking on lease as on today, correct?
Yes, sir.
Last point is, since you are calculating the present value of lease payments today, that means the lease payment you are going to make for 30 years. Lease is suppose 30,000. Lease amount is 30,000, you are going to pay for 30 years. So you can take present value annuity factor. Find out the present value as on today. That should be at least 90% of the fair market value of the asset as on today. So in IFRS there are different rules, but you are reading US GAAP, so I am explaining these points to you. Once give a reading to this, I'll move forward. So accounting by lessee, leases that do not meet any of the four criteria are accounted for as operating leases. That means if there is transfer of ownership, one criteria met, capital lease. This met, capital lease. This met, capital lease. This met, capital lease. Or any one of them met, capital lease. But if not any one of them met,
Operating lease.
operating lease. Okay. That means no transfer of ownership, no bargain purchase option, not held for 75% of the life of the economic estimated economic
No,
life,
the
and
present
PV
value
of
equal
payments
or
is not at all there
90.
in this case. Now, this is important point. So now we were discussing now that we have to calculate present value of lease payments. For that we require what?
The discount rate.
So that discount rate is nothing but going to be implicit interest rate. That implicit interest rate is nothing but discussed rate between the lessee and lessor. So if this implicit interest rate is not given, then you have to take incremental borrowing rate. Incremental borrowing rate is nothing but if you would have not leased that asset or if you would have bought that asset, then what interest you would have paid to the bank, correct?
Yes, sir.
So lessee computes the PV of minimum lease payments using its incremental borrowing rate with one exception. If lessee knows the implicit rate computed by the lessor and it is less than the lessee's incremental borrowing rate, the lessee must use the lessor's rate. That means the lessee to compute the present value of lease payment should use the implicit interest rate. If he knows that, that means if he has discussed or the lessor has discussed that with the lessee. But if he doesn't know that, if he has no idea what lessor is charging on him, then he can calculate the present value of lease payments with incremental borrowing rate, correct?
Yes, sir.
So the recoverability test, minimum lease payments, minimum rental payment, guaranteed residual value, penalty for failure to renew and bargain purchase option. Executory, see what are we discussing here? You are doing an investment,
Recovery of
correct?
it. Yes, yes.
Yeah, and
Recovery of.
recovery of that investment. So 90% test. So minimum lease payments, minimum rental payment the lessor will get from lessee. They will the scrap value would be there. If the lease is not renewed, then penalty, then bargain purchase option. Executory cost, these are the cost. Generally this all is met by whom? Lessee, correct or wrong?
Yes, sir. Correct.
Who will make the minimum rental payment? Lessee. Who
Let's
will
see.
get the residual value of that? Lessee.
Let's see.
Who will make the
Penalty.
penalty
Let's
payments
see.
for not renewing the
Bargain purchase
lease?
of.
Lessee.
Let's
Bargain
see.
purchase option who has? Lessee.
Let's
And these are also the cost he is going to bear. Insurance, maintenance and taxes, correct?
see. Yes.
But this should be kept separately from the lease payments, minimum lease payments. Asset and liability accounted for differently. Asset and liability recorded at the lower of the present value of minimum lease payments or fair market value of leased asset. So lower of these two should be taken and should be recorded as asset or liability, correct?
Yes, sir.
Either you should, either whatever you are finding out is present value of minimum lease payments, excluding executory cost, which we discussed in the backside, or fair market value. Any of them which is less or lower, we should take and account as asset or liability. Asset and liability accounted for differently. Depreciation period. If lease transfers ownership, that means if there is a purchase option in that, so definitely that is going to be purchased by the lessee. So he can depreciate the asset over the economic life of the asset. Okay.
Yes, sir.
If the lease does not transfer ownership, then you can depreciate the asset over the term of lease for 10 years, maybe. If the lease term is for 10 years, that means you had an agreement for 10 years. Okay. Now we will do a question. So please read this question. Now,
It's a capital
on
lease.
January 1st, 2007, Berg Corporation signed a 5-year non-cancelable lease for a machine. Terms of the lease called for Berg to make annual payments of this at the beginning of each year. So he is taking, who is taking the property on lease? Berg Corporation for 5 years, and it's a non-cancelable lease. So first point is it is going to be a finance lease, correct?
Yes, sir.
But let us see more points. And there is some lease annual payments he is going to make beginning of each year, not at the end of the each year. So you all already know when we make payments beginning of year or end of the year, what kind of annuity factor we should take, correct?
Yes, sir.
One is annuity due and one is annuity regular. You know that, na?
Yes, sir, I know.
We have already done that in the investment decisions chapter.
Yes, sir.
So they are paying the lease from Jan 1st. Machine has a life of 6 years. This is the unguaranteed residual value. We don't know whether we are going to get this or not. Burke uses the SLM method for depreciation for all. That means he will show the asset in the asset side of the balance sheet, so he has to depreciate it now. And the borrowing rate is 10%. Lesser's implicit rate is not known. If it is known, then we would take the implicit rate, correct? So what are they asking? They are asking some simple questions. What type of lease this is, and compute the PV of minimum lease payments, and they are asking journal entries. So you tell me what kind of lease this is?
Capital lease, finance
Of
lease.
course, the heading itself is there
Yes.
given, but we will see the criteria. Transfer of ownership not mentioned. Bargain purchase option not mentioned, but we have to see any one of the criteria is met. Lease term 75% of the life of lease property.
Yes.
Yes, you are taking for 5 years. The economic
Finally,
life
it's for
is
6 years.
6 years. So 83.3%.
Waiting.
Like it is like 83.3% of 6 years, 5 years. Okay, so more than 75% of the economic life of lease property. PV of minimum lease payments. Yes, PV, present value of minimum lease payments. 90% of fair
90%
market value
of
of property, correct? But we
yes.
don't know the fair market value, so we will not go for it. It's a capital lease. One of the criteria satisfied. Okay, then we'll compute the present value of lease payments. Payment is this. The annuity factor is this. For 5 years, 10%. This is the PV of minimum lease payments. And this is, we will not compare this with the fair market value because we don't have. So we will capitalize the asset at this. Am I right? This is the asset, and again lease liabilities for 36,144. Are you understanding?
Yes, I understood. I got it.
And the lease liability to cash, the rental. This is the amortization schedule. lease payment you are doing, this is the lease liability for you. This would get reduced and become 0. This is the lease payment. So from 36,144, what would happen first year?
From lease payment,
Uh,
we'll remove interest and then we'll subtract the amount, like
yeah,
actual
yeah,
amount.
yeah. And like first, when you make the first payment, there is no interest, correct?
Yes.
Am I right?
Yes, I got.
And then this is what, and the interest expense is 10%. This is the outstanding amount, isn't it so? So what has happened is
Yes.
this is a lease liability. The first payment is done on the first day of the year. This is like immediately removed. That is reducing the liability to 27,476. And in this 27,476, we are going to pay interest of
10%.
this is deducted from this. This is the principal element. Now again, principal will be subtracted from this. This is what, again outstanding
Again
amount
10%.
10% interest. Again the difference is this principal element. Again reduce from this. This much is
10%.
what you got. Again interest. Again principal element. Again this is what, then 0. Okay.
Yes.
So again accounting depreciation expense. So 5 years. The depreciation is for 5 years of the asset. So expense to accumulated depreciation and interest expense to payable. Okay. On the outstanding amount. And again, this is the final thing. This is the cash which you are paying as an expense. This is a combination of reduction in liability and interest expense.
Yes.
Correct?
Yes, sir.
Hello.
Yes, sir. Hello.
Your liability is reduced by this much, so it comes in the debit side.
Yes, I got it. Yes, sir.
Yeah, yeah. So we are doing a comparison of finance capital lease with operating lease. I think this is going to get finished. Then we can do lesser in the next class. I thought of winding up this by today itself, but I don't want that. I want you to perfectly understand the things. Okay. So depreciation expense is this, interest expense is this, so total expenditure is this. In case of capital lease, you are going to show the capital cost and the interest, correct? This is going to be a lease expense. Am I right?
Yes, sir.
In operating lease, it's a fixed amount. So difference you can clearly see, and it becomes 0 at the end. Fine.
Yes, sir. Yes.
Yeah. Because in case of capital lease, like what happens, the interest element, it decreases with passage of time as the liability goes on decreasing. In operating lease, the payments are fixed, but at the end we are paying this much only, and the difference becomes 0. Okay.
Yes, sir.
So Zarina, then what we'll do today, we have done the like leasing in the books of lessee. Tomorrow we will do the leasing in the books of lesser and
Yes.
put a full stop to this chapter. Okay.
Okay, sir. Like,
Hello.
yes, sir. Yes, sir.
Yeah, tomorrow will be the last class for leasing. Then I can go for the financial reports. I'll just finish 5-6 chapters in a flow in this reporting
Yes.
now. Okay.
Okay.
Yes.
Yes, sir. Okay.
Okay, then we'll take the class tomorrow. See you tomorrow. Okay, sir. Thank you. Bye bye.